This bull market is officially 10 years old. No one knows the ins and outs of its benchmark index, the S&P 500, more than Howard Silverblatt, senior index analyst, index investment strategy at S&P Dow Jones Indices. So I hate to break this to you, but investors really aren't that interested in history, except about what it can tell us about the future. So when you dug into all the numbers, what do you think has the most bearing on where we're headed?
The time duration is a major item here. This is the oldest bull market, so the question obviously comes up, is it too tight to continue on? Okay, so that's the first item you look at, and then is the strength that it's had. It's nowhere near the strongest one, but we did have a 17.5% annualized total return for that time period. So as you said, the question is going forward as compared to bragging rights from yesterday at the bar. What's continuing to keep the market right now is several items. It's earnings per share and net income for companies. Obviously, we had the tax cuts that really helped and came through, especially in Q4, which had some poor earnings, but the tax cut made up. So it's the earnings that are going to make the determination. Earnings are determined to some degree by consumer spending, which goes back down to jobs as well as disposable income. So those are the items that are going to make it going forward in there. The big tailwinds obviously are China, if we get an agreement or some kind of agreement, and the market is starting to gear down a little bit on when we're going to get that, but it's definitely expected. And the other one obviously is spending itself.
Hey, Howard, it's Heidi here in the studio. You mentioned in your research that consumer discretionary and tech, the leaders during the current bull market. Are you still looking to those two sectors to take us to potentially the 11th birthday?
Not consumer discretionary that much. It's very, very cyclical. It goes up and down a lot. I mean, it was a big cut when we went down in 2007, as well as even in the tech decline. So the rebound was bigger. Again, it's where you're coming from to where you're going. IT, on the other hand, is the largest sector in the index. It accounts for over 20%. Second is healthcare at less than 15%. So their earnings are paramount to the index. So that's where the important part's going to go, and that's where the dividends get paid for, by the way. Tech pays more in dividends, kind of strange, but they pay more in dividends, even though it's supposed to be growth, than any other sector. So it's tech where I'd start to look for.
Howard, do you think that we can support this bull market that we have right now? And at what speed can we support it? I mean, what type of growth are you expecting here throughout 2019?
Looking at the 10 years, obviously significantly less. The first couple of years we had to come, just surviving was important, and being able to come back from where we were to make up from the financial crashes on there. Growth is definitely small, and that's what's bogging the market down right now. Fourth quarter earnings, as I said, were not good. We have to accept those. Going forward, most of the street's accepting a lot lower growth rate, but the question is, what will we be settled for, and how much is international, how much is domestic? Domestic still going strong, maybe not as strong as we want. Internationally, we've seen all the indicators. Everything is slowing down. We're even seeing additional stimulus last week from the ECB. So it's the growth is going to be a single digit on this side. If we can get higher multiples to justify, that would increase it. That's what helped us in 2019 so far for the gains, but we have to see.
I was just really surprised at how much a percentage the dividends paid into basically having an increased return. For energy, it was something like 63%, materials 20%. We talk a lot about buybacks here. Were you able to tease out any of the impact that buybacks have had?
No, buybacks go basically on the earnings, obviously, but the buybacks, the major item, and by the way, this quarter, the fourth quarter that we just finished, is another record amount of buybacks. The buybacks, by having all that additional buying, supports the stock and pushes it up, reduces the amount of float that's in there. So there's fewer stocks for you to go chasing and get after. We can't quantify how much it might have happened because it's over literally 10 years. You have to negate every other item. But there's no doubt that buybacks over the last several years has added a big upward pressure to stock prices because it's gone in there and there's more buying. Again, if you've got 3 people bidding on your house, you're going to get more than 2. Doesn't change the value of your house, but it sure changes the price that you're going to get.
And one other question here, just about rebalancing. Is there anything, we don't actually talk about it a lot. Is there anything that investors need to be thinking about with rebalancing afoot?
Well, longer term, if they look over the last couple of years, and definitely into this quarter, the one that's going to be coming up March 18th, starting on there, the share counts continue to go down. There's fewer shares out there. The buybacks and the retirement of share count reduction has reduced what's out there for investors to go in, and as more and more people put money into the market and control it through their 401ks and retirement accounts, there's fewer places to go to. Again, it's more money chasing fewer shares, which adds to upward pressure. That would be the takeaway.
Thank you. Howard Silverblatt, Senior Index Analyst, Index Investment Strategy over at S&P Dow Jones Indices. Thank you so much.
Thank you.